Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Ariel Property Advisors, Sterling National Bank, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AVR Realty Company, Amerant Bank, Bank of America Merrill Lynch, B6 Real Estate Advisors, Briarwood Organization, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handler Properties LLC, Handler Real Estate, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Matone Group, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Meringor Family Foundation, and these friends. Opportunity zone. What is an opportunity zone? All you hear today, all these seminars are on opportunity zones. So in order to explain the latest changes in the regulations in the opportunity zones, and also to discuss this unique thing as an opportunity zone REIT, I've assembled a group, or I should say my group members have assembled a group of people to provide their insight on opportunity zones update. My guests, they include James Nelson, who is a principal and head of the Tri-State Investment Sales at Avis & Young. The man behind the Opportunity Zone REIT, Brandon Lakoff, founder at Bellpoint REIT and Bellpoint. Sundar Jabbanathan, who is a principal at Certis Partners. And last but not least, our tax specialist, Abe Schlistenfeld, co-partner in charge of real estate at Marks Paneth LLP. So since you are the professional over here, explain what opportunity zones, what it means, and what it means to the individual investor who might be watching the show.
So in a 30-second overview, it's basically if an investor has capital gains in 18, 19, or even going forward, they take their capital gains. It can be stock, art, real estate, any type of capital gains. They roll it into an opportunity zone, and they get to defer their tax. They don't pay the tax currently.
Okay, and there are 8,700 opportunity zones around the country.
Yes.
But what is an opportunity zone?
So the zones were designated, I was trying to stay onto the tax aspects. So the zones were designated by the governors in the 50 states, and these were basically loosely based on the census that was taken back a few years ago. That being said, there are some zones that maybe don't necessarily fall into what you would think to be an opportunity zone. The concept behind it was to help regentrify those areas.
Right, and to invest money into the areas, also to invest money into real estate and operating businesses, which Brandon happens to have both sides over there. Correct. So what happened in April?
In April, the major changes that came out, we were all waiting for some more guidance from the IRS. I'll hit on some of the big ticket items. There was a lot of uncertainty as to whether or not, in the real estate world at least, you can refinance a property, take out your money, especially a lot of investors needed cash in 2026 to be able to pay their taxes. So we got some good news there where they are very generous to the taxpayers, allowing them to take out money and being able to utilize the increase in value of the property to take out funds, no different than the real estate world has always, operated.
Which is wonderful.
Exactly. Another big hiccup that was clarified, which doesn't help you that much, but there was a lot of uncertainty as to whether or not you can have a multi-asset fund. The way the original regulations were worded, it appeared you need to have a single asset fund in order to get the tax benefits. There's still a little confusion as to exactly how to work that, but for the most part, that's been clarified. Another big thing when it comes to real estate is it appears that there won't be any depreciation recapture upon the sale of the property. We'll see if that gets changed or not, but as of today, it appears that there won't be depreciation recapture, which again is a huge bonus for everyone investing in these.
Well, what we wanted to do is not just opportunity zones. We were actually looking at really REITs as an alternative for investing. We want to fix a lot of the problems with real estate investing. We wanted to have a lower cost structure. So we were working on the REIT structure prior to 2018. And then when we saw what happened with Opportunity Zone and then also 199A, which is another tax benefit in the same act, by marrying it with the REIT structure and the Opportunity Zone tax benefits and the 199 benefit.
Explain to my audience 199 benefit.
So dividends that are distributed through a partnership or a REIT structure, you're only taxed 80% of the income is taxed at ordinary income rates. So you don't get, it doesn't get sheltered with the Opportunity Zone capital gain benefit. It's ordinary income that's coming from the rental revenue. However, partnerships have all these limitations, and I don't want to get into all the details of the limitations, but partnerships have all the limitations, which if you're a high net worth individual, you won't get that benefit. However, REITs are exempt from all the limitations, which means it doesn't matter if you're a retail investor or you're a high net worth investor, you automatically get the 20% benefit.
Now, what is a REIT share going to cost?
It's an arbitrary number that we picked, which is $100 a share. Most REITs usually issue $10 a share. We want to be different because our whole model is different.
Okay, under the REIT structure, you normally have to give away 85% of the earnings, correct?
So 90% of the taxable income has to be distributed. And then that 90% will be taxed at only at 80% because of the 199A.
Who's going to be able to buy this? How are people going to learn about this REIT?
Well, because we are the first and only public Opportunity Zone REIT, non-accredited investors can also invest in our structure. In a private structure, if it's a private equity fund or private REIT, only accredited investors would
Okay, for my audience, explain what an accredited investor. I know what it is, but
it's really the difference between high net worth and not high net worth. It's really based on your net income or your assets. I think the level is $1 million. You have to have free and clear outside your home and your personal property.
Okay. Sundar, what are you doing today?
So our structure is a little different because we are a deal-by-deal vehicle. So we raise Opportunity Zone money deal by deal by nature.
Each deal is a separate Opportunity Zone fund.
That's right. That's right.
Okay.
So that's been the structure. There's some opportunities to potentially merge them and commingle them, but generally we're raising
let's talk
capital
about specifically your project that you're doing on 125th Street.
Sure. So that's a project that we bought the initial site in October. And when we were talking to investors about that site, back over the summer, it's always been in a QOZ, but I think that feature, even as recently as this past summer, people didn't really understand what it was. And the deal really had to stand on its own merits, and then the QOZ benefit kind of was incremental. Now we're seeing that shift where the deal still needs to stand on its own, but we're seeing new investors coming into the deals that are finding us by the QOZ structure.
Now, are these investors specifically coming in because they have the capital gains from some other investment that they've had in the past?
There's generally two flavors. It's people that are real estate investors that are coming out of partnership gains, and if you're coming out of a partnership, you generally have 180 days from the end of that year.
Identifying the property, right.
So that gets you basically till the end of June this year. Or you have people that are coming out of stocks and bond sales and art and collectibles, and they have 180 days from the time of the sale, which gives them a little bit of a shorter fuse. So those are the two buckets.
Now, with regard to, did you buy that property from this gentleman over there?
We did. We did.
So let's talk about the property before, what the value was before it was an Opportunity Zone and afterwards.
Well, yes. So
I mean,
I think first of all, Sundar got a great. He did very well on the price. I mean, I will say.
But here's my point. Before the Opportunity Zone was really realized or explained over there, You had a site on 125th Street, which is a very strong market, but it was East Harlem. As an opportunity zone, you look at it and say, I could postpone my capital gains for a number of years.
That's right. Yes, and I think Senator makes a great point that the deal still has to stand on its own. You should never make an investment just for the tax benefits. So I think what it has done is that it's opened this up to an enormous new audience. I'd heard a stat out there that there's $6 trillion of embedded gains in the market. Now let's hope everyone doesn't run and take that out of the market at once. But there's not going to be enough of these real estate investment opportunities, and I think again it's going to open up a whole new world of investors, not just the real estate investors, because a lot of them will still tell you that they prefer the 1031 exchange. Why? Because you can continually defer, kick the can down the road. In this program, you are going to have to pay your capital gains tax by 2026. You do get a 15% discount, but clearly the grand slam here is getting that stepped up basis in 10 years and be able to sell tax-free. When have you ever been able to take profit tax-free, with the exception if you sell your own primary residence and you get $250,000 per married couple? So that's really the windfall, and what we're trying to advise investors is this is clearly a national program. As you said, there's 8,700 areas where you can do this, but if it were my capital gains, I would be looking for areas where in 10 years, where are you going to see the best appreciation? And I think looking at New York City and really the whole metro area, as we were discussing before, is a very good bet where you're going to see that kind of appreciation.
Now, you were saying before you're investing in Tennessee and other places.
We want to be diversified, so we don't want to just be in the Northeast. We like around universities. We like being around the country, from Portland, Oregon to Massachusetts to Southeast. So really, we're looking for job growth and population growth.
Now, you had also mentioned that you're part of the opportunity zone, as opposed to real estate, is to operate businesses, which we were talking about. You could be operating a hotel. You can be operating a manufacturing facility.
That's correct.
You can be operating any type of business. So you're trying to do that with a mattress company.
So yeah,
correct?
we invested in a mattress company in the beginning of 2018. We are moving the facility to an opportunity zone in New Jersey. We've chosen not to bring international to China and have manufacturing done in China, partly because of opportunity zone benefits, but also we want to have American-made product. So we decided to make that investment in Jersey and keep it here.
Have you seen companies who are planning to do their operating a business in opportunity zones, or are you seeing more investors?
It's right now, I'd say it's more investors, because the real estate community is very quick to jump onto these kind of things. But as you mentioned, this program was really initially designed for these businesses and to stimulate growth. So we're talking now to tech companies, to real estate companies that are saying, let's relocate our business to these areas. And I think you had even mentioned some of these areas would surprise you: the Lower East Side, the West Side of Manhattan, Long Island City. And so not just to get that real estate benefit, but if your plan is to sell your business in 10 years, to be able to do that tax-free also is pretty compelling.
Yeah, I like to call it phase 2 of the Opportunity Zone program, because a lot of these developers are also developing office buildings. And once those office buildings are starting to go up, then they're going to be looking and soliciting a lot of the businesses and saying, we're an Opportunity Zone, and may be able to benefit.
Why is a company going to get a benefit operating in an opportunity zone?
So if a business operates in an Opportunity Zone, the operating income every year doesn't get the benefit. But at the end of the day, if they can sell their business, they get the same benefits that any real estate owner gets. Same 15% cut on the capital gain in 2026 and 0% tax on the appreciation.
Brandon was saying before in the green room that it's longer than the 10-year hold. Why don't you explain what we're talking about that?
I think it's the difference between having a single asset fund versus a multi-asset fund. And our structure being a REIT, we want to have a multi-asset fund so it has greater diversification. Because of that, if you have a private equity structure, you're typically going to have a 3-year investment period. Thereafter, you have to wait 10 years to get the opportunity zone benefit, and then it's going to take you another 2 years to sell the assets. So you're looking at 3 plus 10 plus 2, which is 15 years.
I got a 15-year situation.
Yeah.
So let's look at somebody over there. I'm going to play tax accountant that Abe is over here. Somebody who's a baby boomer, who may be in his late 60s, early 70s, going into the situation. It's a 15-year hold.
Well, that's a private equity structure. If you go
Correct.
with a REIT structure, you solve
No,
that.
no, I
or
understand.
if you do a single asset,
Right.
then it's only 10 years. So I think the investor has to figure out what their strategy is. Do they want to only be 10 years and then want to pick their investments? Then you're going to pick a single asset
So
fund.
my question is, what do you're besides the real estate practice, you're also involved with the high net worth individuals. How are they coming to you and people are saying, what should we do? In the same way that they're going to James and saying this, what are you recommending?
you
I mean, it's a very difficult recommendation.
You started off the show asking what changed in the new regulations. So if you go, you were talking about inside baseball. So if you go back to the videotape of the show that we taped approximately 5-6 months ago on opportunity zones, one of the things I mentioned I was concerned about was under the initial regulations, there was a big detriment to older high net worth individuals investing because there wouldn't be the opportunity zone benefits. Under the new regulations, their ears step into their shoes and get the benefits.
So basically, the question on the estate taxes is what I want to know.
So they get
Tolls.
they get the benefits. They step into the shoes of the decedents.
Michael, to go back to your question on what an investor should be looking for, because we're going to be reading about all the things that went wrong probably about 2 or 3 years from now. You have to remember, to qualify for this program, all you have to do is check one box on your IRS tax form. So what's going to happen is, Main Street USA investor is going to start putting money in these funds that maybe they don't have an experienced real estate operator, or they don't currently have assets. So when friends ask me, when investors, what should I be doing? Well, if you're going to go with a fund or a REIT, make sure they control the real estate. And the fact that you're already seeding this with specific investments that they can see is perfect. Obviously, with what Sunder's doing on a deal-by-deal basis.
Deal-by-deal basis.
Yeah.
Now, what about the crowdfunding approach on the opportunity zones?
I can't really speak to that space, but the one thing that we saw, CoStar, I think they reported that there's 116 funds that have now been identified with a total target raise of $18 billion. So again, and it's still amazing to me that you're the only one doing it in a public format.
Yeah, but we were talking before about UBS is marketing an opportunity fund. Bank of America will be Merrill Lynch and all this. Who are they gearing it to? Is it going to be a $100,000 investment?
Well, it's more of a high net worth individual. It's they're not selling this to non-accredited investors, so they're really focused on accredited investors, so high net worth, and they're sometimes going to be diversified. And they're going to be.
How do we compare this to the tech model? Because a lot of people, going back 10, 15 years, invested in the tick model. Somebody sold their home, they invested in this deal, there was a tick, they bought a shopping center, they had a piece of the shopping center, but unfortunately retail had some difficulties.
Correct.
Right.
I think the biggest risk you're going to have is construction risk. And if you don't have good managers who are managing the property correctly, and really the construction, because one thing that we talk about has to be new construction or heavy renovation, or substantial renovation, I call it. So it's all construction based. So if you don't have a team that is experienced on construction, that's your risk. That's the real risk.
There are developers who are building projects to 95% completion, and then they're taking their paperwork, giving it to Opportunity Fund buyer and saying, okay, you put the building in service, right? Now you qualify for first use and you operate. So that would be an example where you could minimize the construction risk. But you do get different opinions on, most of the council and accountants I'm speaking to now say they are okay with first use.
Especially after the second set of regs that really clarified that.
But then what price are you paying for that property? That's the other part.
Thank you, the markup.
Yeah.
Right.
That's
It's 25%. So the stat for the U.S. is that if you look at all the opportunity zone properties that sold last year, year over year, it's a 25% increase, whereas the rest of the market, all the properties that sold outside opportunity zones declined by 2.5%.
My comment is this. You buy the asset, which is 95% complete. That person who may have built that asset is now selling it at additional price for a higher markup than the fair market value that might be.
because they have to pay tax on that.
But what I'm saying to you is, it's fine for a developer who's 95% complete. I could see it right now. Many people in New York City, they built the building, and not finished. They can put it, the building was built not under the presumption of the opportunity zone, and here's a great opportunity. Aren't you building something on the west side also?
We are.
So if you built that building, okay, and then brought it to Brandon,
Right.
okay, because it's a building and they have people from the Avalon Bay days that they understand the property over here,
Right.
you could take a markup at a higher price because it's going into the zone. It's going to be used immediately and it works out. So it's, James, now you have a new additional sales opportunity.
Yeah, most definitely. And we've looked at deals in Austin, Texas, and we walked away because we felt we were paying market or above market, and we had lease up risk. It has to be original use. So if you can't have any tenants in there, so you're still taking risk because you got lease up risk. It's an empty building.
You know, we have different asset classes in business. We have residential. You spoke about student housing. You're talking about manufacturing. Which asset class do you see the best opportunity? And I hate coining the word opportunity.
Right.
You know, you might be able to take a property in a shopping center, an old mall, and reconstruct it over there into the opportunity zone in a neighborhood over there.
Well, the way we think about it, you already have, as everyone said, development risk. So you have this big construction risk component that is inherent in most QOZ deals. So we try to de-risk everything else. And so we try to de-risk the asset risk by doing residential, and we try to de-risk location risk by doing it in New York City. And so
Right, and that's why I asked the specific asset, okay? You know, the residential is the high situation. Now, office has a great opportunity also in different markets, depending on where the area is. I mean, you got to look.
But when you talk about where's the market going to be in 10 years, and that's when the investors start getting nervous.
That's my crystal apple. It's over there. It's not in my hand. I don't have it.
So where is retail going to be in 10 years? Where is industrial? I mean, I don't think we're ever going to be able to replace or figure out a way where people won't need to live in apartments.
Okay,
so
but
that's,
you know what, as I said earlier when we were in the green room, the biggest problem that we have is that people, when they make an investment today, think about what it is today. They forget that, there's a capital call, there might be additional money. You built this multifamily and it's working, or you're renovating the multifamily, but you need more money because the insurance has gone up, the real estate taxes have gone up, and everything like that.
So I solved that problem. Public REIT, there's no capital costs. It's our job as just like any other corporation to be able to raise the capital, through new equity, new debt, to be able to solve those issues and not put the pressure on investors having to put more capital in. Because if they have to put more capital in, they have to put more reinvestment of capital gains, and they have another 10-year clock on the new capital they put in.
And they may not have capital gains.
They might have, yeah, correct.
So here's the question. How does the individual consumer learn who they should go to, for a single asset or the REIT opportunity? Do they find out from calling Charles Schwab? Do they find out, because, when you go to the internet and you put in the word opportunity zone, you see Google has many ads because those are companies who are specifically advertising this. Or how do you make the due diligence, which is your responsibility, okay, of who's the best asset to deal with?
So I don't want to beat a dead horse because it's been said a bunch of times already, but I just want to reiterate it because it's so true, and I tell every single person I speak to about opportunity zones. If it wasn't a good deal last year, it's not a good deal this year. I mean, that's the numero uno. Now, and part of it being a good deal is who's doing the deal. Every single person that is doing opportunity zone funds, and you guys included, are going around to many seminars, many conferences, many lunches, dinners, events.
But how does somebody
ask questions?
Right.
It's track record.
Right.
Have you done it before?
I think you're asking more of a marketing kind of question.
Right.
And I think it's your tax attorney, your tax accountant, your advisor. It could be your broker who is representing you on a sale, and he says, "Hey, I know a good operator, or a good fund manager, or a good REIT manager." So I think it's a bunch of different avenues, but mostly advisors are the ones advising their clients, and the tax professionals are advising their clients
Although
where to invest.
For us, I think the answer is pretty simple. It's our existing investors. We don't have, as a single deal-by-deal structure, we don't have distribution arm, we don't have a sales group. So it's all word of mouth from investors, and what they're generally finding when they look through that is you really are just underwriting a developer. That's really what this
And
process is.
and I think that's what somebody has to emphasize. If you're going to get involved with one of these, make sure that the developer, the end user, is somebody who has a good proven track record.
100%.
Well, for us, when we started this first development, so our development team in this QOZ business is a joint venture between our company, Certus Partners, and the Hakimian organization. So collectively within our development entity, our first development deal in a QOZ will probably be our 33rd or 32nd development deal in New York City.
The Hakimian organization. And that's what I'm saying. I think the real key, and when you talk about Bell Point and the Avalon Bay and the other products over there, is legitimate. And when you're talking about Avis and Young, it's who's selling the property or the project that you have to look at.
You can also look at the track record.
That's what I'm saying.
This is not their first project, so you have to look how many projects they've done in opportunity zones, how many construction projects have they done, have they been successful in their last 5 or 10 projects. So I think you got to look at their track record. And I think one of the other questions you asked was well, if you're looking, if the viewers are, where do they go? Depending on what your net worth is. I mean, you may not qualify for a lot of private equity fund structures, which is why we did the public REIT structure, because we're the only structure that can allow non-accredited investors.
So I think in conclusion, I'm happy that Abe has returned to give us his foresight and intelligence. I'd like to say thank you to James, Brandon, Sundar, and needless to say, Abe. And I'll see you next week. And the opportunity zones are not for everyone. That's what I want to preface. Yeah. Okay, for the right people, it may be a decision, but we're not making endorsement. They're not for everyone. Thank you again.
Thank you.
Thank you.
Thanks.